If you live in South Florida, there are two things that are guaranteed to happen. One, it's a random rainstorm on what is supposed to be a sunny day. And two, it's construction that will always cause a delay on your way back home. But what does that mean from a business standpoint? Today, we're breaking down the pavement industry. I'm Jake Tobin, and I'm a licensed business broker with Transworld Business Advisors. And as a business broker, I work directly with business owners in navigating exits, growth decisions, succession planning, and acquisitions. And today, we're going inside the asphalt industry, and specifically its relation to construction, infrastructure, and real estate development. This is an industry that is often overlooked, but can be a great investment opportunity. So, what does it mean to have a pavement business? At its core, the industry is responsible for building and maintaining the roads, parking lots, and paved surfaces that keep commerce moving forward. These companies typically handle asphalt, concrete paving, seal coating, striping, milling, resurfacing, and general repair work. Some focused on large scale infrastructure projects, others concentrate on commercial lots or residential driveway. Their customers usually include municipal or government entities, commercial property owners, HOA and property managers, industrial facilities, and residential clients for the smaller operators. Now, this is a project based, equipment heavy business. It is driven by infrastructure spending, real estate development, and reoccurring maintenance needs. Compared to many service businesses, there are real barriers to entry. First, there are licensing and regulatory requirements. Contractors often need a state contractor license, local business licensing, bonding for public contracts, and proper insurance coverage. You need general liability, workers' comp, and commercial auto. Second, this is a capital intensive industry. Equipment is expensive and it's unavoidable. A typical operator may need pavers, rollers, dump trucks, and a milling machine just to compete effectively. In addition, they may want a yard or a storage facility and sufficient working capital to cover payroll and materials, especially on large projects where payment cycles can lag. Operationally, success depends on skilled labor, accurate estimating, competitive billing, and strict safety compliance. Entry is possible, and scaling profitability requires discipline, systems, and a strong management. Buying a pavement company is not solely based on revenue. Buyers have to consider the equipment, the crews, the contracts, and execution capability. One of the biggest risks is the equipment condition. Heavy machinery depreciates quickly and requires constant maintenance, and eventually demands replacement capital. A neglected fleet can dramatically reduce value. Cash flow timing can also create stress. Weather can delay jobs, and government contracts may pay slowly. Buyers must understand the seasonality and working capital needs. Labor is another critical factor. Skilled operators are not easy to replace, and crew retention directly impacts production quality and your margins. Finally, many of these businesses are owner driven. If the seller controls estimating, bidding, and key relationships, the transition becomes riskier and becomes a major factor in the valuation. On the seller side, clean financial reporting, it's essential. Many operators mix personal expenses, run cash jobs, or underreport revenue. While this may be common within construction, this creates valuation friction and reduces the buyer's confidence. Buyers also want assurance that contracts and relationships will transfer smoothly after the closing. And without that confidence, deal structures may include some sort of holdbacks or earnouts. Valuation in the pavement industry largely depends on the size and structure. For a smaller owner operator business, generally under 2 million in revenue, they're typically valued using a seller's discretionary earnings multiple. The common range is 2.5 times to 4 times discretionary earnings, where stronger companies may push towards a 4.5 times if they are having reoccurring maintenance contracts, diversified revenue, a modern fleet, and a reduced owner dependence. Lower multiples apply when the owner is essential to the operations, equipment is outdated, and revenue is volatile. For mid market companies, they're valued using an EBITDA multiple instead of discretionary earning. The typical range is 4 to 6 times EBITDA, and higher multiples are justified by a strong backlog, government contracts, multiple crews, established management, and a geographic growth opportunity. Ultimately, several factors drive value more than anything else: equipment quality and the remaining life of that equipment, signed contracts and backlog of work, revenue diversification, management depth, clean, consistent financials, and stable reporting gross margins. Asset value often sets the floor, but profitability, sustainability, and transferability determine the multiple. From an investment standpoint, pavement companies offer exposure into infrastructure spending, real estate development, and reoccurring maintenance demand, all without being tied to trends or consumer fads. These businesses generate revenue from essential services that municipalities, property owners, and commercial operators cannot ignore. For anyone looking to diversify income, paving can provide strong cash flow, hard assets backed through equipment, and opportunities for operational improvement. When you combine cost control, diversified contracts, and a capable crew, this industry can produce durable earnings and long term value, creating room for a strategic buyer to scale and build equity over time. If you found this video insightful, like and subscribe. And if you want an industry broken down, leave a comment down below. Stay tuned for more insights from inside the industry.